And now introducing Mr. Keith Lanton.
Hi, good morning. Welcome to Monday, October 3rd, first day of the fourth quarter of 2022. Most market participants are very happy to wave goodbye to the third quarter, which was one of the rougher quarters the financial markets have endured in several years. And we'll talk about the outlook for the fourth quarter and beyond, as we certainly have lots of near-term uncertainty as markets are digesting and assessing the rapid rise in interest rates, both in the United States, led by the Federal Reserve, as well as many other central banks following the U.S.'s lead. And this has caused a great deal of dislocation, as we've talked about before, and is something that is not precedented in the last 15 or 20 years. So many market participants haven't seen an environment like this. Bond markets appear to have adjusted more rapidly than the equity markets to the rapidly changing environment. And we see that with interest rates on bonds in the 4% range for treasuries. And for municipals, we're seeing 3, 4, 5% yields depending on maturity and time horizon, offering many opportunities for those who have patience. And Brad will join us to discuss municipal market and other markets as well and give us his insights. The stock market seems to still be digesting the new regime at the Fed and the new mindset, and has continued to grind lower. We also had the let's call it the blow up at the UK Gilt market, and some of the shocks that are still reverberating from that, affecting markets. But equity markets initially started to decline as PE ratios came down, as interest rates went up, and now we're contending with declining E in the PE, declining earnings. So valuations and equities getting affected both by multiple contraction and the concerns that earnings are going to be lower than previous. And we'll talk some more about what levels may make sense in markets to start to nibble or bite or devour, something we talked about last week. And we'll talk about if you are inclined to think about the markets and timing. We've also talked about is virtually, or in my opinion, completely impossible. So when you get to find stocks that you like at levels that you like, it is a time, in my opinion, to at the very least be nibbling. You need that long-term horizon. Investing in the short term is a fool's errand, and we have to have our eyes and sights set on horizon and know where we're going. And this is a good opportunity to think about how to invest in the next 10 years. And Barron's cover story talked about that, and we'll dive into that. Before we get started, focus on what we should be keying on that horizon and that long-term view. And I'm going to share with you some thoughts from the book The Alchemist, which is a book by Paolo Coelho. And this is a novel that talks about truth and the meaning of life and self-development. So things that we can all do better in our lives and all help us focus not on the day-to-day, which is rocky and volatile, just like the financial markets are a metaphor for that, but that long-term perspective. And if we have that long-term perspective in our lives, we'll be able to have that long-term perspective, hopefully, in our financial pursuits. So he goes on to say that there are 4 obstacles of life, and those 4 are being told since childhood that what we want is impossible, and therefore we believe it. Love, which is something that many folks have experienced from birth, and then go on with partners, and the trials and tribulations are certainly too numerous to count. Fear, which drives many of our innate or guttural responses, and fear is certainly a driver of many poor investment decisions. And finally, the fear of understanding our dreams and not delving more deeply into what we want and how we can get there. He says that, some quotes, it's the possibility of having a dream come true that makes life interesting. And then on that same topic, there is only one thing that makes a dream impossible to achieve, and that is the fear of failure. We try and focus every day on the positive and all the blessings that we have, and when we ignore our blessings, many times those blessings can turn into a curse. Speaking on love, when you are loved, you can do anything in creation. And on the thought on how we should go about our day-to-day, everyone seems to have a clear idea of how other people should lead their lives, but none about his or her own. All right, with that long-term perspective, we're going to now dive all the way down, and we're going to look and focus right now on short-term and where we are today and what's going on in the financial markets. Right now, S&P futures are about 25 points above fair value, about the highest that I've seen them this morning. NASDAQ futures also higher this morning. NASDAQ futures right now are about, where are we? About 45 points over fair value. So not as dramatic as we're seeing in the Dow. And S&P futures are about 28 points above fair value this morning. And this news coming on reports that the UK's finance minister, Kwarteng, doing about face, saying the plan to cut taxes for high earners is going to be abandoned. That news provided some support for the pound, which is up about 0.3% to 112 versus the dollar. And the UK government bond market also taking some cues from this action and is lower, prices higher, as the markets digest the reversal from the UK finance minister. But the British markets are also having to digest the negative news that S&P is going to be revising its outlook to negative from neutral on UK government bond ratings, citing rising fiscal risks. Also in Europe, we saw September PMI readings face some downward revisions from preliminary estimates for Germany, UK, and France. Trading was light in Asia, with China closed for a holiday. South Korea was also closed for a holiday. And in Japan, the finance minister over there talked about intervening again to support the yen if necessary. One of the headwinds markets facing this morning are reports that OPEC Plus is reportedly considering a production cut of over 1 million barrels per day at Wednesday's meeting. That's leading oil prices higher by about 3.5%. And that is a factor that the markets are going to have to contend with as rising energy prices is one of the issues that has contributed to the overall market weakness. And this action from OPEC Plus in the face of the Ukraine-Russia war is not welcome by financial markets. In general news, President Biden signed a bill to fund government through December 16th, which includes $12 billion in funding for the Ukraine. Congress is now on recess through mid-November. In Brazil, they had an election over the weekend between President Bolsonaro and President De Silva, Lula, as he's affectionately known. He is a former president who spent some time in jail. Luiz Lula da Silva secured the most votes, but not enough to prevent a runoff. Current President Bolsonaro received more votes than anticipated, and the polls were off with expectations there, so they will face a runoff in the next several weeks. Russia retreated from the city of Lyman. That's just days after it annexed the region, according to the New York Times, and growing concerns that as Russia is backed into a corner, that they may consider more desperate measures. And President Biden and other world leaders, including the Pope, out warning Russia against taking drastic action. Here in the U.S., 800,000 people in Florida are still without power following Hurricane Ian, and reports now are up to over 70 people having died in the storm. Hurricane Ian will cost insurance companies about $63 billion, according to Bloomberg. Some individual companies in the news today. The biggest newsworthy company is Credit Suisse. They are attempting to reassure investors over their financial condition and their liquidity after the value of their credit default swaps has increased significantly, and we're in that circle of crisis when a financial services company has to reassure investors that all is good. That only perpetuates the concern that all is not good. So Credit Suisse stock is dropping this morning. The stock's down to multi-year lows, perhaps all-time lows, trading around 368 here in the U.S. Stock had been as high as 10 just a few months ago, and investors increasingly worried about their ability to remain solvent after Credit Suisse has endured many crises, some self-imposed, some would argue, in the last year to two. Wells Fargo this morning upgraded to buy from neutral at Goldman Sachs. Tesla down about 5% this morning after reporting it produced over 365,000 vehicles and delivered 343 in the third quarter. The estimate was they would have delivered 364,000 vehicles this morning. So moving on to what we have to look forward to this week. We have some important economic reports. Today we get the Institute of Supply Management releasing the Purchasing Managers Index for September. The consensus estimate is for a reading of 52.3, roughly even with August. A lot of attention will be focused on the prices paid component of the index, which has fallen for 5 consecutive months. And the hope is that we will continue to see meaningful declines in the prices paid, and the greater hope is that if those prices decline, that they will be passed on to the consumer, and we will see moderating CPI is the hope. Later in the week, on Wednesday, ADP releases its National Employment Survey for September, and the ISM releases its Services PMI for September. Thursday, we get the initial jobless claims, the weekly report. Those claims will be coming in better than expected, which sounds good, but in the back and forth world that we're currently in, where good news is bad news, more people working is considered to be inflationary, and that bad news is outweighing the good news that more folks are working. Speaking of folks working, Friday, the Bureau of Labor Statistics is releasing the jobs report for September. Consensus estimate is for an increase of 250,000 non-farm payrolls after a gain of 315,000 in August. Unemployment rate expected to stay unchanged at 3.7%. That will be the number the markets key on this week. So moving to Barron's. Barron's talking a lot about the actions in the equity market, the Federal Reserve, and the importance, as we started out at the outset, of how to think about investing over the next 10 years. Starting with the Federal Reserve and the rise in rates, Barron's trader column, the Fed is starting to break things. The stock market is paying the price. Some would argue that one of those breaks might be Credit Suisse, and other folks would say that if you were to get a big break somewhere, whether it's a meltdown in a financial services company, a more significant meltdown in a government bond market, like we saw with the gilts, but perhaps something that spirals out of control, that's when the Fed may start to reverse course. The stock market desperately wants to put in a low. The Federal Reserve right now is just not in favor of it. On the one hand, U.S. economic data remains strong as jobless claims fell below 200,000 for the first time since May in that weekly report we just talked about last week. And that's stoking concerns that last week that the Fed is going to have to keep raising interest rates to slow down inflation. And then on the other hand, the rest of the world seems on the verge of imploding. The mess in the UK, the concerns about Credit Suisse. So last week the stock market didn't take the good news all that well, focused on the bad news, and we had markets in the U.S. drop 2.7 to 2.9%, depending on which index you were focused on, but all three indexes finished the week at new 52-week lows. At the end of trading last week. There were just 12% of NASDAQ 100 stocks above their 200-day moving averages, and just 4% were above their 50-day moving averages. Of course, the numbers could go lower. There's always zero. But even bear markets become temporarily washed out. If you're looking for a near-term indicator of a potential bounce, Barron's had a discussion with Frank Capillari, who is the founder of a technical analysis firm, and he noted that last week on Wednesday we saw the markets bounce 2% to the upside, and he noted that the 10 days following a 2% rise after big drops have been made have been among the best periods for the S&P 500 this year. So perhaps we will see a near-term respite. Perhaps today is the start of that. We'll see if we can hold on to today's gains. But nevertheless, this is still a bear market, and it's likely to stay that way until we reach some sort of inflection point to change directions. The odds of a big blow-up are rising. Bank of America has a stress indicator index that indicates the level of stress that markets are in, or when we're potentially near a blow-up. And that indicator is at the 74th percentile. And when it hits the 75th percentile, you start approaching a scenario where the conditions are ripe for some sort of blow-up. If you're looking for levels to start dipping into the market in select groups that you've been waiting on, some commentary from strategist Richard Farr at Merion Capital Group, suggesting that the market currently is trading at 15 times 2023 earnings, down from its peak, but near historical averages of 15 times earnings. And now, I mentioned earlier, we have to focus on earnings as we turn the page and begin the October quarter. In order to stay at 15 times earnings, because this is 15 times forward earnings, we need earnings to increase 8% in 2023 from 2022. If we don't see that 8% rise and we see 2023 earnings come in identical to 2022's, then if you were to maintain a 15 PE, you'd be taking the S&P down to 3,300. And if you think things are really bad and you go back to 2021's earnings on the S&P, then you'd be looking at an S&P at around 3,090. And I think that goes back to one of the commentators that we spoke of last week. When you're at 3,600 on the S&P, which we're at roughly now, maybe a good time to nibble. If you get to 3,300, be a good time to considering biting. And if you get closer to 3,000, you may want to become much more aggressive. And as that commentator said, start gorging. Those are sentiments that I would agree with as well. Barron's talked a lot about the UK and their market interventions, and where there may be the next problem in the European Union and what to take a look at. And Barron's suggests that Italy is the most likely next crisis candidate. Its public finances are uglier than the UK's, and its new Prime Minister, Giorgia Meloni, has promised relief for Italians squeezed by soaring energy costs. The ECB recently came out with a new facility called the TPI facility, which allows it to buy a particular Eurozone government's bonds. The thought process here is that if a particular country in the EU came under pressure, that they have a facility to handle a coordinated push to sell off their securities. That the EU stands ready to assist. But the ECB President Lagarde has said that the purpose of this TPI facility is not to bail out policy mistakes. Nevertheless, some have called the TPI, which stands for Transmission Protection Instrument, to really stand for to protect Italy. Since January, the yield spreads of Italian 10-year bonds over German bunds has nearly doubled to 2.4%. From 1.26% in January. So if you're looking for canaries in coal mines, that would be a place to look. and keep an eye on what those Italian spreads are doing relative to the stronger European economies. The Fed put, which is something that has come to symbolize a rescue for the equity markets when we have a sell-off, something that the Federal Reserve has implemented, whether they acknowledge it or not, since 2008. Barron says it isn't dead; it's just a long way off. One of the reasons you might argue that equity markets haven't fallen more is the expectation, or perhaps if you're someone going short, the concern that the Federal Reserve will step in and take action to help out equity markets. Barron's saying that they don't think that the Fed is on the verge of any intervention, but if things were to get significantly worse, and I emphasize significantly, then you may see the Fed step in to take action. One area where the Fed has not taken action is in the fall off in interest rates and the move higher in government bond yields. And like the VIX in equity markets, which measures volatility, there is an index called the Merrill Lynch Option Volatility Estimate, or MOVE Index, which shows how violent action has been in the U.S. Treasury market. And that index has reached its highest level since 2009, with the lone exception of March of 2020. So if you're a bond investor and you're feeling that the markets are gyrating like you haven't seen before, well, you have possibly seen it if you're around in 2008 or March of 20. But other than that, the volatility is at multi-decade highs in the Treasury markets. As you're looking at the spill-on effects or spillover effects of Fed policy, one of those has been the strong dollar. Another casualty of the rapidly rising rates and the change in Fed policy is this rising dollar. And if you're looking for reasons of stress or concern in the markets, another to look at is how high the dollar goes, and whether or not the dollar reaches a level that is outside the comfort zone of central bankers. But one other factor to focus on with the strong dollar is the strong dollar presents challenges for S&P 500 companies, as they receive 40% of their income from overseas markets, and they bring it back here to the U.S., and they have less money because those currencies that they earned all that money in are weaker relative to the dollar. Now, that 40% figure for S&P 500 earnings is not uniform. Some of the S&P 500 companies get a lot more of their sales overseas, and those you may want to keep an extra eye on. So Philip Morris International, symbol PM, gets virtually all its sales from overseas. Mondelez International, MDLZ, gets 3/4 of its sales from abroad. Booking Holdings, which acquired Priceline here in the United States, gets 86% of its sales from outside the United States. And Lam Research, LRCX, gets more than 90% of its sales from abroad. So you may want to think about international sales and what that may mean for earnings as you review your portfolio. So I talked about that long-term horizon and what to think about over the next decade. And Barron's had an article along those lines on that theme. Turbulent times are here to stay. How to invest for the next decade. This year, investors have endured a nearly daily onslaught of market-moving news, sketching a picture of slowing economic growth, elevated inflation, and flagging fiscal and monetary stimulus. In response, the S&P 500 has declined more than 25% from its record high, and perhaps even more surprising to some is bonds have lost about 14% of their value since January. Amid all that carnage, it is easy for investors to get caught up in the here and now, yet investing success is achieved most dependably with long-term perspective. With stock and bond indexes projected to have low single-digit returns for the next market cycle, a long-term portfolio should look very different going forward than it did in the past 10 years. Barron suggests looking at active stock picking rather than deploying passive indexes, which have worked extraordinarily well in the last bull market, and adding to fixed income, which has been a drag for the last 10 or 15 years. One simple way to begin would be to reconsider the 60-40 stock-bond portfolio, and this 60-40 split had a terrible start to the year. it's down about 20%. So if you started the year 60-40, it's stocks and bonds, you're down 20%. Bonds didn't give you the ballast that you expected, but with yields now north of 4% on treasuries, and we mentioned 4 to 5 on munis, and 7% on preferreds, and 5, 6, 7% on corporates, you're getting a lot more ballast from your bonds. The truth is, no matter how you divvy up your portfolio among asset classes, the market downturn makes this a much more compelling starting point for investors looking to put new money to work. In fact, if you're just putting a little money in every week into the markets, whether it's through your 401k or some sort of savings plan that you set up, now would be a great time, given how low markets are, to see if you can squeeze a little bit more in now that prices are lower. If you can save a little bit more and invest it in the market, again, not suggesting a dive, slow, steady investment process, but assets are lower across the board, and asset class starting prices are the best predictor of future performance. So when you got the low starting values, and we're certainly a lot lower now, the probability of seeing better returns over time goes up infinitely. Cash-generating investments are back in vogue for the next decade. Higher volatility adds to the uncertainty of investing in fixed income markets, but higher interest rates mean that you are certainly going to be receiving higher cash flows for your fixed income investments, and that will make a big impact on the price change of your fixed income investment. So if you're earning 5%, and you earn 5% over 2 years, assuming no compounding, markets, meaning bond markets, have to decline 10% before you're in the red. If you go back just 7 or 8 months ago, that same investment might have been yielding 1.5%. You just needed a 3% decline to be in the red. So these higher rates have a meaningful effect on returns. They also have a higher and meaningful effect on growth companies. When you discount back the earnings of growth companies, which are anticipated to make earnings in the future, and you discount them back using higher interest rates, you wind up with companies that are growth companies with meaningfully lower valuation. So if you are going to step into the markets, where does Barron suggest looking? They say there are opportunities for stock pickers in innovative new frontiers. The labor shortages we're experiencing and the shift in supply chains back to the U.S. will spur investments in factories that rely more on robots and automation. Renewable energy will continue to take share from fossil fuels, albeit slower than initially thought. Genomics, telehealth, and big data will transform the way people receive healthcare. And different than the last 10 or 15 years, Barron suggests that success won't only be going to the companies that make the technology, but to those using it, they will become more productive, efficient, and competitive. Moving forward, they think the new winners are not necessarily going to be the tech makers, but the tech takers. Some examples of tech takers would be banks enjoying higher interest rates, bigger margin spreads for net interest margin, but also significant investors in technology, and they're able to utilize this technology to reduce time spent on labor-intensive tasks. They're also able to build out more advanced apps, which means that they need fewer physical bank branches, significantly reducing real estate expense. Healthcare companies are finally, truly beginning to go paperless. When you go to your doctor, you're starting to finally see the benefits of computerization. A lot less pen and paper in doctors' offices. Companies like CVS and United Healthcare are becoming increasingly automated, and that will benefit their profit margins. When you're thinking about companies that are transforming their businesses by going increasingly technologically oriented, you can think of John Deere and how they are not just selling tractors, but selling a complete technology universe to farmers to more efficiently harvest and treat their crops. Companies like McDonald's, Chipotle, Wingstop are able to have fewer workers in their restaurants as they automate the order taking process as well as the food creation process in their businesses. Finally, just going to mention one article in Barron's, and it's the bond article. And the title of the article is "Bond Yields Are Finally Looking Attractive. What to Buy Now?" I won't get into the details here since we'll listen to Brad and get his insights on where the opportunities are. I'm going to turn it over to Brad. Give us those insights. Good morning, Brad.
Good morning, Keith. Good morning, everyone. I hope everyone had a peaceful and relaxing weekend, which as investors and investment professionals are becoming more and more important so that we can maintain some sanity during these turbulent times. This is one of the worst markets many of us have ever seen, with no place to hide in stocks or bonds. In hindsight, many of us just wish we had accepted zero, and some elder statesmen that I knew did accept zero. The only issue was that they were the type of people that were always willing to accept zero. Over time, the market does work out as long as one keeps their expectations reasonable and intact and makes logical decisions. Just one thing before I go into my written piece. The bond market is way up this morning. Yields are lower. Normally, I would say I'd be excited about investing in bonds here, and I'd say this is really good for the market. My concern about the bond market rallying today is, as Keith was mentioning about Credit Suisse, with everything that's gone on here internationally and World Bank, I have no idea what's going on here, and it's a little bit concerning to me that this could be a real flight to quality. So just be careful this week. Watch what's going on. Listen to the headlines, and let's see what's happening. The rest of the bond market, meaning municipals, corporates, may not rally with the government bond market here. This could just purely be a flight to safety. Last year at this time, I remember talking about 15-year 2% municipals as being cheap to the market. They were cheap to the market because they were yielding 150% of what you could get for the equivalent treasury, and that was in tax-free form at 2%. Those bonds are down almost 30% on paper now. The fact that you get your money back at maturity does not provide solace for seeing the fixed income section of your statement severely damaged. At the beginning of this year, we talked about 15-year 3% municipals being cheap to the market. They were, at that point, also yielding 150% of treasuries. Those bonds are now down around 20%. It's all sickening. We haven't seen moves like this. I haven't seen them in my career. So today, I am here to tell you that you can buy a 15-year 4% bond at around a 4.15% yield to maturity. What's crazy is that in bond trading terms, they're not quote-unquote cheap. They're trading at 105% of the comparable treasury as of Friday, maybe a little bit better today. Not 150% as they had for the past year. However, the term cheap is used to discuss the valuation of municipals relative to treasuries. So I would say that although these bonds are not quite cheap, so to speak, they are of fair value, but most important, they are now attractive and livable rates of return. 4.15% is better than 7% tax-equivalent yield for those in high tax brackets and high tax states. If one were to buy, for instance, a high-grade 4% bond due March of 2037 at 4.15% yield to maturity, that's a dollar price of 98.38. That's an investment of $98,380. At maturity, in 14 and a half years, to be exact, you will get your $100,000 of principal. Over the life of the bond, you will also get $58,000 in tax-free coupon payments, and if you were to reinvest those coupons at 4.15% tax-free, it's an additional $20,400 of tax-free interest. So that would be a total of $178,467,000. So this is basically a $90,000 tax-free return in 14 and a half years on a $98,000 investment. If you have a 15-year horizon, don't even look at the statement. Of course, we are human and cannot control ourselves, but let's put this into historical perspective. This is a pretty nice rate of return and return of capital. I'm going to feel like a jerk if a year from now I am talking about 5% bonds yielding 5.15% in 15 years, and of course anything's possible, and we can only do what seems logical at the moment. It would be fun to have a crystal ball, but it would certainly take the challenge out of life, and make our jobs irrelevant. I hope everyone has a great week, and I'll send it back to Keith. Thanks.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. This podcast is available on most platforms, including Apple Podcasts, Spotify, and Pandora. For more information, please visit our website at www.heroldlantern.com.
Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.